Right. Right. We'll start today where we stop here. Basically, what we discuss up to now is basically non-resident taxation and double tax avoidance agreement. Uh, we discuss the main principles of double taxation and what is mean by residency principle, source principle, and revenue sharing principle. The mainly we are dealing with these two, the residency principle and the source principle. So then mostly it is relevant when we are dealing with double taxation. So we discussed that part, and the models, two models are important. You to have understanding. We discuss in detail what are the models is basically available. It is OECD and UN model. You need to have some sort of understanding about these different two differences of in these two models. So we discuss those things, and then again we discuss how many DTAs available as of now. 45 countries we have DTA with, and also then there is this is we call it as bilateral agreement. Then we have one multilateral agreement. We have SAARC countries. We have separate agreement for double tax avoiding purpose. That one also you can refer if you are really interested in double taxation and fiscal evasion relating to international taxation. So we discussed the main important principle here, the permanent establishment. Permanent establishment. We discussed the basic one, the permanent establishment. I will again recap the permanent establishment because it is really important in the case of double tax avoidance, double taxation. So the concept of PE is used to double tax avoidance to tax profit from business conducted in other contracting states, because basically you can see the highlighted word avoidance purpose. Then the concept of PE is used to double tax avoidance, the tax profit of a business conducting in other contracting state, because PE concept is very useful in the current context where just assume a foreign party, they are doing a service here, then we need to see whether there is a PE, whether there is a PE or not. So that is the main principle. If there is a PE, then anyway it is subject to tax in Sri Lanka, attributable to that PE. Basically, then if there is a PE, then we need to tax it only the portion. Which portion you need to tax? Only the portion which is attributable to that PE. This very important point is attributable. At the exam also, these wording are very important when you are writing down. So the attributable scenario, right? You can refer the business profit is taxes. Then the business profit is taxed under DTA only if there is a PE situated in the country. We are not going to tax each and every person unless there is a PE or not. Then there are some separate articles when we are discussing the DTA. Then there may be a royalty, there may be interest. So those things we are dealing with separate article. We call it as passive income. Then those things we are not going under PE concept. But if they are doing a business, basically from a business is again important here. The business conducting in other context is business profit. Business profit is important here. Business profit is tax. You need to mix, no need to mix it. Then if it is royalty, rent, not the rent, royalty, interest, you might have dividend, you might have technical fees relating to India and Vietnam only. Then those things are dealing with separate article under DTA. Then other than those, passive income, we call it as rent, interest, royalty, And dividend, we call it as passive income because they are not directly involved in when they are getting income. If any person who is getting income like a royalty or interest, they are not doing exactly the involvement. It is very less involvement. They even, let's say interest, the foreign party, they have provided loan to the Sri Lankan company, then they are getting just interest income without doing anything, right? Then we call it as passive income. So those things, anyway, tax it separately under the separate article. Each DTA is having separate article for royalty, interest, and dividend, as well as there are two treaties. You can refer India and Vietnam. Those countries having basically technical service fee. If there is a technical service, we need to deduct the applicable rate. Then I will give a summary of this while once we are completing this section, summary of treaty. Then it is very really useful for your assignment as well. The individual assignment. I think this is at the end of the session. I will share the individual assignment guideline. Then you can refer those things as well. And the deadline also I will explain soon after the session, right? So this is, will read it again. The business property is taxed only if, really important this part, that is why highlighted in red, only if there is a PE situated in that country. Let's say in Sri Lanka, there is a, if it is a PE, then if there is a PE in Sri Lanka, to tax the attributable profit, not the entire profit, whatever the attributable profit, we need to tax it, right? Then PE is not a legal entity, but it is a concept under tax treaties. Because there is a no legal entity here, we dealing with as a concept. We can't find exactly legal entity. There may be some legal entity, some scenario you might not find out any legal entity, right? Then we'll move to the continuation of this PE concept. This is the continuation of PE. Then this is really interesting part with example. Then an enterprises of a one contracting state, let's say Indian company, then one contracting is taxable in other contracting state, let's say Sri Lanka. They are going to taxable in Sri Lanka. Indian company, they are going to tax in Sri Lanka only if that enterprises maintain a PE. If there is a PE only, right? In the latter state, that is Sri Lanka, right? Maintain PE in Sri Lanka. And only the extent that, see the word in, only to the extent that the profit earned by that by the enterprises in that state, in enterprises in Sri Lanka, are attributable to PE, profit is attributable to PE. Then the attributable wording is again important. This is only to the extent that profit is attributable to that PE, right? Very important. Then if there is a no PE in Sri Lanka, that enterprise is not liable to tax in Sri Lanka, right? If there is a no PE, then not liable. This is very easy. No need to hard. This is not a hard and fast rule. It is very easy concept under the DTA provisions and double tax avoidance agreement. Then if you can summarize this para and keep it in your mind by applying to different countries, then I had some student getting understanding about other contracting state. If you can use this para to have a understanding, it is very useful to keep it in your mind. So then Then a PE. A PE could be grouped into 4 different types. Here we can divide it into PEs, we can divide it into 4 different types. First one is basic rule. Basic rule, what is the basic rule? That is, we call it as asset or activity type. Then PE, basic rule, PE. This is basically, you can see if there is a fixed place of a business to which business is enterprise wholly or partly carried on. Fixed place in the business is wholly or partly carried on. Then if there's a business, then if they have a fixed place under this rule, there must be a place of business. You can see the summary of this place of business, and the place of business must be a fixed one. You must have a place of business, then the business must be a fixed one. This is basic principle under PE, right? Basic principle under PE. There must be a place of business, and business must be a fixed one. And business of enterprises must carry on through a place of business. Then they have to do the business. Basically, this is main principle of PE, right? This is main principle, basic rule. Then there are other PE concept as well, different types. Then the next type is, you can see, this is basically, if you have an office, then we can categorize as a basic rule. If you have an office, then that is a basic PE concept. You are having an office, you have a table, chairs, and you are doing something there. Then that is called basic rule under basic PE, right? Fixed place is there, fixed one carried on a business there, right? You can have example as office. If you have office, you can categorize, right? Then the construction PE. What is construction PE? What is mean by construction PE? Construction PE is different one. It is business site, sorry, building site or construction installation project constitute a PE again. Then the keyword is building site, construction, or installation project. You might have some sort of the big installation project. The government, most probably they are having some installation and some construction. Then they are having kind of water bodies engage in some construction activities, purifying water system and so forth. Near to Karani River these days, they are having the big project. And so many building side as well. If the foreign party is coming and doing the business, let's say a foreign company, Chinese or Japan company, you can see near to Colombo, 10 areas, there are some hospital project is carried on by foreign parties, the Chinese people. Then the Chinese peoples are here in more. Then you can see the near future even the children will get the name Sinhala plus Chinese name the near future. Then because we know that there are coming to here and doing lot of construction activity as well as other business, engage in other business as well. So then these kind of construction are going on. Then if they are coming into the Sri Lanka, let's say Chinese company, they are coming into the Sri Lanka and doing a business with a construction, doing the construction. The hospital, they might have a hospital, they might doing a big apartment complex, hotel complex, they may be, right? Then it is also can be categorized as a PE if it at least the period of, if they if they stay in Sri Lanka doing the business while doing the business more than 183 days. If they're doing that construction more than 183 days, that is basically 6 months. If they are doing construction here more than 6 months, then we can categorize as a construction PE. Then they are doing construction, there's a PE, they are liable to tax in Sri Lanka. That is only thing you need to keep in mind. They are having construction PE. The examiner might give different scenarios you to analyze. They are doing construction, this kind of activity, whether they are liable to tax, they are coming from China and doing the business here, whether they are liable to tax. You can directly say that if they are, you can evaluate the scenario and see whether they are exceeding 183 days or 6 months, more than 6 months, then you can decide quickly. Then they are having a PE in Sri Lanka and liable to profit which is attributable to that PE, not entire profit, which is attributable to that PE, right? This is easy, right? Then the agency type PE. What is called agency type PE? Then the agency type PE is one of the again key area. So in chartered exam also they have tested this thing, agency type PE. An agent could also establish a PE if the following condition are met. These things I am reading because first I would like to emphasize the relevant section and the wordings, and later I can take some example to elaborate the detailed explanation. So here PE, if the following condition are met, these are the condition you need to meet. Otherwise you can't categorize there as a agency relationship, principal and agent relationship. So these are the three conditions you need to keep in your mind to evaluate whether there is a agency PE or not. Then the first condition is there should be dependent agent. There should be a dependent agent or independent agent acting outside the ordinary course of his business. Then there should be a dependent agent, right? Dependent agent. Dependent agent is totally depend on the principal, right? Then let's say Sri Lankan company or Sri Lankan individual even or company, let's say they are totally depend on the whatever the parent company, maybe UK company or India company, Singapore, maybe wherever in the whatever the country, then the principal is there, but agent in Sri Lanka, let's say ABC is everything is doing what the principal is asking. Then the what if principal asking to hold your hand up, then they will hold. Then if principal asks to stand up, they will stand up. If principal asks to sit down, they will sit down. Likewise, totally depend on the principal. That I told that in order to understand the concept, then the totally depend on the principal. Then we call it as dependent agent. Then the independent, there may be a agency PE. The independent agent acting outside the ordinary course of his business. See the wording? Outside the ordinary course of his business. Then he is, let's say, Sri Lankan company, they are doing buying and selling some apparels, right? Then they engage with the some other countries, one of the company, let's say, they engage with them and they nominated this company as a agent, and they are asking them to do whatever they are asking, even normal ordinary course of business. Then they are not directly involved in the normal ordinary course of business. Then outside the ordinary course of business, they will act in separately. There may be some other production line, even though they are buying and selling. If the principal is asking manufacturing, they will import clothes and whatever the raw material, they will manufacture and supply. So this is kind of no outside in the ordinary course. That is also we can categorize as a depending on the principal. Then they were doing only buying and selling apparels. Then the one of the company influence and came into this Sri Lankan company and asked them to manufacture and sell to other countries. The relevant order also given. Then we can categorize they are acting outside the ordinary course of business. Then we can categorize the principal in that country also is liable in Sri Lanka, which is attributable to that PE. The principal is liable, not the agent. Agent is anyway liable in Sri Lanka, whatever the profits and income, whatever the things they are doing. Then the principal will become an agency PE, and principal is liable to tax, which is attributable to that PE. Right? Then agent must act on behalf of an enterprise. Then you need to check whether he is acting on behalf of the enterprise. Whether he is acting on behalf of the enterprise. Whether agent is acting on behalf of the enterprise. And here I will read this one as well. Agent must have a authority to conclude contract, because this is also supportive in the second one, which is binding for the enterprise, and he must habitually exercise his authority, this authority. Then the principal authority, I will explain now. What is act on behalf of that enterprise? Basically, agent is anything, whatever the activities principal is required, he will act. He will represent as a parent. He will represent then maybe IRD, maybe a registrar of company, any other bank related issues, they might go and visit and act behalf of principal. And also they are engaging with the contract with parent, and they will engage with customers and sign the contract on behalf of the principal. Then they will sign on behalf of the principal. Then we can categorize them as also agency type PE. Then these conditions are met. If these conditions are met, we can conclude there is a agency type PE, agency PE. Then these three conditions, you need to, in the given scenario, you need to analyze whether these conditions are meeting in order to determine whether there is a agency PE or not. Then see the next point is service type PE. Service type PE is basically furnishing of services. Furnishing of services including consultancy service. Then the service PE. We categorize as a service PE. Basically furnishing of services including consultancy service. Here, if it is consultancy service, we can categorize there as a PE. Then, and also by an enterprise to employee or other personnel via activities of that nature continue within the country or a period or periods engaging, here important, 180 days or more. Within any 12-month period, you know exactly what it is. We explain with deeper examples. So, within 12-month period. Within any 12-month period. Within any 12-month period means whatever the commencing date, you can go forward or backward and see whether there is 12 months. And during that period, whether they are exceeding 180 days. So then you can determine there is a PE. Right? Then the service type PE. I will take an example. Let's say foreign consultancy service company, they are coming in Sri Lanka and providing a service. If they are engaging that company with Sri Lankan company and providing that consultancy service, then the service they are engaging, maybe some engineers. There are some engineers, if we don't have that kind of technical knowledge of engineers, if we don't have in Sri Lanka, what we do is we hire in from some other firms, international firms. Then they will come into Sri Lanka and check, and they will provide their service. Sometimes they say Uma Oil project. Let's take example. The Uma Oil project, it is a big, massive investment. Then the engineers from different countries, they are coming and giving their technical support to in order to complete that project successfully, even though it is doubt of successful. So whatever in order to complete the successfully, they will provide their consultancy. So then that firm, if they are exceeding 180 days, then they can determine, then we can determine there is a PE, service PE, right? Then they may be that enterprise to employees of that country, that company, or other personal independent service providers also maybe, right? This is service type PE. Then we call it as 4 type of PE. Basically, basic rule, construction type PE, agency type PE, and the service type PE. Then according to the DTAs, right? These are the main concept. If you are referring DTA, every DTA you will see this permanent establishment thing is the important part of permanent establishment. If you can go through with permanent establishment, you can these points are very important. You can see these points. Then commonly we are discussing, we can't go one by one due to time limitation. We can't go one by one each treaty and read it for you. That will take time. Then we can do entirely throughout the session. All the session we can only complete the DTAs. So therefore we are discussing here whatever the important concepts, right? Then the business profit is one of the key area when we are going to discuss with DTA. If you can refer the DTA having separate article for this. Whatever the PE one also, you are having separate one. If you can go through with the PE, permanent establishment, here, this one, you will find out separate article for PE, right? You can link these theories to that DTA, relevant DTA when you are referring that DTA, right? When you are referring that DTA, you can refer this summary of DTA thing, right? Then again, if you can refer the same time the business profit as well. So business profit here, again I will read it for you in order to have better understanding. The business profit of non-resident person. Non-resident person, the profit of a non-resident person, enterprise. Let's say enterprise is a company, let's say, shall be taxable in contracting state. Then they are liable to tax in Sri Lanka only if, again, what carries on a business in Sri Lanka the very important part, through a PE. We need to find out what kind of PE. Then if it is basic PE or construction PE, agency PE, service PE, right? Then if you can go to DTS, there may be some example as well. The office, management, so many example is given under DTA. If you can refer more detail, you can refer the DTS as well. So then through a PE, here is a summary. Then shall be taxable in contracting state only if carries on business the through a PE. It's very clear. Situated in Sri Lanka. Situated in Sri Lanka. So then, since it is established that there is a pre-E, since it is established that there is a PE, right? Let's say, sorry, once it is established that there is a PE, if we say, there is a PE, if we say, right? Then such enterprises carries on business in that contracting state through a PE. Then it is important part. Profit that may be taxed in Sri Lanka. Tax in Sri Lanka are only so much, which is the very important part attributable to PE. It's very clear. If there is a PE, then whatever the profit they are earning is taxable in Sri Lanka only so much is attributable to that PE. It is very clear. So whatever the bold wordings are very important you to get concept clear, right? So in determination of profit of a PE, the deduction shall be allowed. The deduction shall be allowed for the expenses incurred locally. Then when you are calculating the profit of the PE attributable to that PE shall be allowed. The deduction also allowed for the expenses incurred locally. Whatever the expenses incurred in Sri Lanka, they can deduct relating to that PE. And also an executive and general expenses incurred for the PE by the head office. And also executive and general expenses. There may be head office expenses incurred by the PE, right? That cost also they can deduct in general term. That there are several treaties, they are allowing head office expenses which is attributable to this PE can be deducted. Executive and general, there may be management fee, there may be reimbursement of some other expenses they have incurred which is attributable to Sri Lankan PE. Those things, whatever the things we can, if it is incurred for the PE, the very important part, if it is incurred for the PE by the head office can be deducted. So then again we need to link here, even DTA says, this para is basically what DTA says, right? What DTA says. But some DTAs they are providing some DTAs they are providing the restriction. They restricted normally, if you can refer India DTA, Sri Lanka, between Sri Lanka and India, there is a DTA. Then it's linked, then you can't deduct entire head office expenses attributable to, it is linked to, if you can refer India, you can deduct only the amount allowable as per the Inland Revenue Act. As if you can refer India, here should be n, right? Then we need to go to the domestic law as well. They are referring to the domestic law. The DTA, India DTA, they refer to the domestic law as well. Then domestic law, what it is say. Let me share the DTA, India DTA as well. This is, yeah. Right. I'll share it again. Right. Here you can see in this article what we, because these are these lengthy paras are there, then whatever the concept you need to keep it in your mind, whatever the things we are discussing in the tube. To know that concept, it is very clear. Then if you can refer the article 5, the permanent establishment. Here the permanent establishment, under this permanent establishment, you can see what we have discussed. The place of management, branch, office, factory, workshop. This is the basic. Then the construction P, building site, construction. So it is says 180 days. Then the furnishing of services is India, in the case of India, 90 days. 90 days in the case of India, but generally 180 days. Then you need to refer one by one each treaty, how it is goes, right? Then here 90 days. But we discuss in the table, in general concept is 180 days. It is OECD model. This is basic general terms we discuss. So then again, income removal properties, you can see business profit, what we have discussed, and this is discussing, right? So here it says in the profit, here there shall allow deduction of expenses, shall be allowed as a deduction of expenses which are incurred for the purpose of PE. Whatever the things we discuss in the tube, right? Including executive and general administration expenses incurred by then the incurred in that state where the payment is written there elsewhere in accordance with the provisions. Here, in accordance, you can deduct general administration expenses incurred under PE situated in elsewhere or there. Situated in no elsewhere. Accordance, here the important part. Here the important part. Right? Here the important part is in accordance with the provision subject to the limitation of domestic law. In accordance with the limitation of domestic law. We can't deduct entirely, but it is subject to the domestic law. What is the relevant section under domestic law? Domestic law, what is the relevant section? Section 79. Section 79 is the relevant section when we are deducting head office expenses. If you are a non-resident person, let's say branch office, you are doing the tax computation, you need to check whether head office expenses are there. Then it is subject to 10% rule, right? The deduction of head office expenses incurred by a non-resident person to a PE should not exceed 10% of assessable income. That companies, the branch company should accessible income, right? I think this part we discuss when we are discussing the head office expenses, I think, right? Uh, yeah, here you can refer the slide number 18. We discuss in detail how with the calculation, I think, right? The 10% limitation is there. Then here you can see subject to the DTA provisions is available under Article 7. Article 7, that is what we discussed short while ago. It article in the India Treaty, they are referring to the domestic law. Then again we need to go to the section 79. There's some DTAs, they are allowing entirely, whatever the irrespective of the domestic law. In that case, you are not going to do this adjustment. You can entirely deduct whatever the total expenses, head office expenses. Right? Hope you got that concept very clearly. Then the whatever the passive income, the passive income, whatever the passive income, you need to keep it in your mind. What are the passive income? I explained when we are from the beginning. What is the dividend, interest, royalty? These are passive income. They are not doing any much effort. If you have dividend, let's say if you are investing in shares, are you incur or are you do any additional effort once you after you invest? Do you? Are there any additional effort you are doing? Are there any additional effort? Right? Are there any additional effort? No. Then you will get only the portion whatever the income they have invested, whatever the amount they have invested, then they will get as a return, dividend or interest or royalty. Right? Then you can see here DTAs confirm the right to tax. DTAs confirm the right to tax dividends. Then right to tax dividend, interest, royalty by the country of resident. See the word in here, right to tax. Right to tax. DTA confirm the right to tax. They are giving right to tax in Sri Lanka. They are given tax in right. We call it as in technical term tax in right. Dividend, interest, royalty, we can tax the country of residence of the recipient by the country of residence of the recipient, but limited right to such dividend, limited right to tax such dividend interest, royalty is given to the source country, limited right to tax. Then the limited right to tax is source country. Then here other way around, I will explain with the example if it is not clear. Then the taxing right is resident country. Let's say company in UK, we are paying royalty. Let's say we are paying royalty. Let's say EY, we are paying royalty to the parent company, UK, right? Then when we are paying, we are deducting royalty, withholding tax on royalty because we have a source, we are the source country. But the resident country is the UK. Then they, whatever the income totally they are getting there, they are liable to pay tax in there, right? Then we have a limited right to tax we have limited right to tax in Sri Lanka as a withholding tax. As a withholding tax. Even that scenario you can apply, let's say Indian company, they are coming to here and providing services. Then if it is services like technical nature, we need to deduct 10%. And we as a source country, we have a limited right because we can't go beyond that. Because we need to restrict it up to 10% only. We can deduct 10%, then balance we need to send it to the India. Then the Indian company, they are liable to tax in India entirely whatever the applicable interest, whatever the tax rate. Let's say 35%, they are liable to tax India. So then it is clear, right? They are paying. So then the second para, dividend interest royalty are comprehensively defined DTAs. Such agreement include paragraphs in the effect. If you can refer the DTAs, there are separate article for each income. Then the dividend, interest, royalty, we have separate articles. If you can refer one by one, the summary is here, right? If you want to explain this one in detail, please let me know. Then the dividend, interest, royalty, how it is come to tax in Sri Lanka. Very first day I explain it with the diagram. With the diagram I explain it how we are going to tax. Then here we are required to deduct withholding tax. Then Indian company, they will pay tax as per the Indian law. Then I will draw a diagram for you to have some sort of understanding. Let me share the whiteboard first. Here, let's see. Here, one company is in Sri Lanka. Then other company is in India. This is Inland Revenue Department, right? Let's say here, here XYZ company, India, right? Here ABC company in Sri Lanka. ABC company, Sri Lanka. Alright, Sri Lanka. Then this is Inland Revenue Department, Sri Lanka, IRD. Then what you need to do is here, they are providing, Indian company, they are providing service into Sri Lanka. Let's say technical service. Then what Sri Lanka company will do is, Sri Lanka company, they will pay for them, for their service. They will pay. So then here I will do technical service. Technical service. Technical service. Let's say 100 million is the amount. Indian rupee or whatever the, let's say rupees 100 million, let's say 100 million. Then you got the invoice for technical service. Then what you will pay is in India, to India, in return, pay, are we paying 100 to India? Can we pay 100 to India? Can we pay? Can we pay entire 100 to India? No, right? We cannot pay entire 100 to India. Then as per the section, what is the section? section 85 1, if I'm not mistaken, 85 2b 2a or 1b. So the technical service, whatever the service the non-resident person is providing, then what you need to do is you need to pay withholding tax 14%. As per the Inland Revenue Act, if you can refer Inland Revenue Act, you need to deduct withholding tax. Withholding tax 14%. IRA says 14%. Then, if you can see, the Inland Revenue Act says, Inland Revenue Act, Inland Revenue, let's say Act says technical service, service 14%. You need to deduct withholding tax on technical service 14%. Are we going to deduct 14%? Are we going to deduct 14%? No. We are not going to deduct 14%. We need to check whether we have a DTA or not. Whether we have a DTA or not. Then we can see we have a DTA with India. We have a DTA with India. We are clear now. We have a DTA with India. Then we are not going to tax entirely 14% because we have a DTA. Then the applicable tax rate is how much? Tax rate is how much? Technical service. I am sharing the India DTA as well. I am sharing the India DTA. Here you can see. Yeah, exactly. The students also providing the answer. That is good. Actually, that kind of engagement is needed at this level. So, technical services and royalty, we have altogether one article. It is Article 12. Then it is 10%. It is 10%. It is 10%. Then are we going to tax in? Are we going to apply 14% or we are going to limit it to 10? Yes, we are going to limit it to 10%. We are not going to 14%. Then as per the DTA, we are going to apply withholding tax on technical fees. Technical fees is 10%. Technical fee is 10%. Right? It is clear now. We are going to apply 10%. Then we are going to pay to India only what amount? Only what amount? We are going to pay only 90. Then balance 10. The 90, how 90 kms? 90 km is basically 100 into 10% is after deducting. Let's say 100 minus withholding tax. Withholding tax means this one. After deducting this, then 90. Then whatever the amount they have deducted, they are required to pay to the Inland Revenue Department. They are required to pay that 10 to the Inland Revenue Department. Withholding tax 10%. How it is? The amount is 10, how we calculate 10? 100 into 10%. And withholding tax. Right? We need to pay to the inland department. Then department will issue a tax deduction certificate. Department will issue tax deduction certificate to them. One is certificate to release the payment release. Then the one is for in order to claim tax credit in India. The other party. IRD will issue what we call it as. Then I'm just drawing here. They will give, Inland Revenue Department will give tax deduction certificate. The separate certificate, we call it as tax deduction certificate to them. It is really important. Tax deduction certificate is really important as confirming they have paid 10 in Sri Lanka. Then the other certificate they will issue to the respective company, to the bank, to release the payment. Then it is to release the payment for payment purpose. Then payment purpose 90. Then these two. Then in practical, the both certificate is taken by the ABC company. They will share both certificate to respective Indian company, because IRD is not sent into the Indian company directly. The practical scenario, whatever the two certificate ABC company will collect and send it to the Indian company. The practical scenario. The theory perspective, I just put a diagram in order to understand well. So then the Indian company will claim that 10% paid in Sri Lanka as a credit. Whatever the source country is Sri Lanka, they paid tax 10. Then whatever the resident country, India, they are the Indian company, XYZ company, they are required to pay tax, whatever the applicable rate. If you want to draw that one as well, I will draw. Let's say this is Indian company tax return. Then they will provide, this is, let's say, yeah, IRD India. The tax office. Yeah, I don't know exact name, whether it is Inland Revenue Department, maybe let's forget about that for the time being. This is Sri Lankan IRD tax office. Then they are required to file the income tax now. Here, what they will do is they are required to pay tax. This 100 applicable rate, let's say 35% is the VAT income tax rate. If it is 35, then they require to calculate 35 as it is, and they can deduct this as a credit, less tax credit paid in India, whatever the 10. Then they need to pay balance tax. Only is how much? 25. Right? I think it is clear now. This is the return. This is how they are returned, the summary basic. This is the withholding tax on. Then you can apply here not only technical fees, but also you can apply other incomes as well. Let's say royalty, dividend, then you can, let's say royalty is also 10%. Then you can apply into this scenario. Then royalty, you can apply dividend, then you can apply interest as well. Not only this thing, right? The same theory, then you can, the rate will be different, right? I will move to the tute again.
Excuse me, sir.
Yeah.
Sir, actually, what do you mean by this? The other certificate, what do you call as that 90
This one.
payment release certificate?
Yeah, this is actually, we use the Department of Inland Revenue. Normally they issue two certificates. One is in order to claim the tax, right, in India, right? The other one is you need to remit it to the India, no? Then normally what you have, every company, they will have a foreign transaction. Then what they do is, when they have a foreign transaction, they will send money through the bank, no? Then bank, the Inland Revenue Department has asked all banks, don't send any money outside Sri Lanka. They need to pay withholding tax. Then bank, if you go to the bank with that 100 to pay that into Indian company, let's say you went to the bank with 100 million, I want to remit this entire 100 to India, right? Then bank will say, no, you can't send 100. You need to pay taxes applicable Sri Lanka and give the confirmation of tax payment. Then they need to come back to the Inland Revenue Department and they need to pay 10 to the Inland Revenue Department, and then they will issue a two clearance certificate. One is to claim the tax credit in India, whatever the respective foreign party. Other 90, they will issue a separate certificate in order to release the payment. Then the banks knows, then the IRD confirming, issuing that this person has paid that respective taxes and you can release the payment. Then they will show ABC company, they will show ABC company, they will show it to the bank. C bank, this is, we have paid taxes 10% to the Inland Revenue Department. This is the confirmation. Please release this 90. Then only bank allowed to release this 90 to the respective Indian company. Is it clear?
Yes.
Clear, no? Okay. මෙතන මොකද පැට්‍රිකලි සර්ටිෆිකේට් දෙකක් දෙනවා ඔයාලට. එතකොට ඔයාලට ඒ සර්ටිෆිකේට් දෙකම හම්බුනහම එකක් ෆොරින් පාටි එකට යවන්න ඕන. අනිත් එක තමයි ඔයාලට බැංකුවෙන් නිකම්ම රිලීස් කරන්න දෙන්නේ නැහැ. පේමන්ට් එකක් ෆොරින් පාටි එකට රිලීස් කරනකොට නිකම්ම රිලීස් කරන්න දෙන්නේ නැහැ. එතකොට ඔයාලට මොකද වෙන්නේ? ඒ රිලීස් කරන්න පැට්‍රිකලි රෙස්ට්‍රික්ෂන් එකක් දාලා තියෙනවා බැංකුව වලට. කිසිම සල්ලි එළියට යනකොට ඒක ෆොරින් ට්‍රාන්සැක්ෂන් එකක් නම් අපිට සෝස් එකේදී ටැක්ස් වෙනවා. ඒකට අදාළ විත්හෝඩින් ගෙවලද නැද්ද කියලා කන්ෆර්ම් කරගන්න කියලා බැංකුවට ඉන්ස්ට්‍රක්ට් කරලා තියෙනවා. එතකොට බැංකුව වලින් අහනවා ඔයා ටැක්ස් ගෙවුවද, අදාළ ටැක්ස් ගෙවුවද කියලා කන්ෆර්මේෂන් එකක් ගේන්න කියලා. එතකොට IRD එක දෙනවා. බැංකුව ඇඩ්‍රස් කරන්නේ නැහැ, බැංකුවේ නම ඇඩ්‍රස් කරන්නේ නැහැ. ඉන් ජෙනරල් සර්ටිෆිකේට් එකක් වෙනම දෙනවා. එතකොට එකක් ටැක්ස් ඩිඩක්ට් ක්ලේම් කරන්න ඉන්දියන් කම්පැනි එකට. අනිත් එක මෙන්න මේ ගාන එයා ටැක්ස් එක ගෙවලා තියෙන්නේ, බැලන්ස් එක රෙමිට් කරන්න පුළුවන් කියලා කන්ෆර්මේෂන් එකක් දෙනවා. ඒ සර්ටිෆිකේට් දෙකයි. එතකොට ඒක අරගෙන මෙයා යනවා ABC කම්පැනි එක බැංකුවට. මෙන්න ABC කම්පැනිය පෙන්නනවා එයාලගේ බැංක් එක HNB කියමු. HNB HNB මෙන්න අපි ටැක්ස් එක ගෙවලා තියෙන්නේ, බැලන්ස් එක රෙමිට් කරන්න. එතකොට බැංකුව දන්නවා හරි මෙයා ටැක්ස් එක ගෙවලා කන්ෆර්මේෂන් එක අරගෙන තියෙන්නේ. එයා බැලන්ස් එක ඉන්දියන් කම්පැනි එකට යවනවා. ඒක මොනිටර් කරන්න තමයි. නැත්තම් ගොඩාක් අය ෆොරින් ට්‍රාන්සැක්ෂන් කරයි ටැක්සස් ගෙවන්නේ නැතුව. ඒක නිසා ඒක වළක්වන්න තමයි මේක දාලා තියෙන්නේ. So then they are getting confirmation as this for 90 and then they will claim as a credit in Indian company. right? So here, then another important point I need to highlight to you, right? In the most recent treaties, the what are the most recent treaties concluded by Sri Lanka, that rate of tax on dividend, interest, royalty generally 10%. You know that generally 10%, right? It is clear. Then generally 10%. There are some other rate as well. If you can, we'll look at the DTA with India as well, right? Then while the stand in withholding tax on dividend and interest is 14% as per the IRA. IRA Act එක අනුව what is the rate? 14%. 14% is the rate for as per the IRA. But treaty says 10%. We are enjoying that treaty rate. In the case of interest, in the case of interest, Inner Revenue Act says 5%. Reason without taking reason changes. If it is reason changes with effective from January 1st, 2020, then it is also liable to the normal rate as per the company, right? This company rate, if it is 24, then it is 24, right? If it is 14, not the 14, it is anyway 24 standard rate, right? Then it is clear with effective from
So
January.
thank you, sir.
Okay, right. It is then 5%. The with effective from 31st December 2019 up to 19 5%. After that 24% with the recent changes. I will explain in the whiteboard. This is, don't worry. Again, the whatever the rates applicable things. Here it is clear that there are two different rate, access different rate, then the treaty says 10%. So then there are some other way around also. Treaty provide higher rate, then let's say India interest income, then it says 10%. But treaty IRA Act says 5%. Forget about the recent changes. Let's forget about the recent changes. Without taking recent changes, let's say interest, withholding tax on interest 5% as per the Inland Revenue Act. Then the treaty rate is 10%. Then are we supposed to apply 10% or 5%?
We are supposed to apply 10%.
Yeah, DTA rate is 10%, no? Because of DTA rate is 10%. Can't we apply 5%? Because the IRA rate is 5%, no? Can't we apply 5%? Because here is the para, you need to keep in mind, this is also examinable point. Tax is withheld the source on the gross amount of dividend, interest, royalty. The foreign recipient of sources, this is gross income, is claim, DDR, this is not, yeah. Yeah, anyway, I will explain this in the whiteboard. Here, this is the examinable point is here. What is that applicable rate we can apply if it is more burdensome in the Inland Revenue Act, if it is more burdensome in DTA. I will explain with the whiteboard. This is very easy to remember. This I am going to have a diagram. Let's say sources. I'm drawing here. This is, you also need to have this kind of diagram in the individual assignment. This is, I will take only for 2 countries. You can continue other rest. right here I am writing down. I'm writing down. This is as per the Inland Revenue Act. Inland Revenue Act. As per the Inland Revenue Act. And here DTA. DTA India. Yeah. Then the DTA is you can merge the cell when you're doing DTA China. Right? Then you can help me when I'm drawing this one. We have whatever the dividend, interest, royalty, resources, dividend, interest, royalty, and let's say technical service as well. Right here, dividend. Here I will take interest. Here royalty. Here technical service fee. Technical service. Right? Technical service fee. These are the sources. Passive income sources. Forget about the technical service because it is not the exactly passive. These are the three sources are passive basically. Whatever the passive sources are, dividend, interest, royalty. This is not the passive, but treaty provide this separate article. Treaty again, they have said that this is separately we can deal with in the case of India and Vietnam. So then if you can help me out, then what are the applicable rate in the case of IRA perspective? Inland Revenue Act එක අනුව rates මොනවාද? Then the dividend without taking into consideration recent changes, let's I will do this thing as well. Let me put this comparison is basically up to 31st December 2020, right? So sorry, 2019. Comparison is applicable, right? Right. Then is 14%. Then interest is what? Inland Revenue Act says 5%. Then royalty, what is the applicable rate? 14%. Then technical service, 14%. Technical service 14, right? You know that these are the rates applicable as per the Inland Revenue Act, right? As per the Inland Revenue Act. This is again 14%. Right. Then DTA with India එක අනුව you can say what are the rates. Now India treaty එක අනුව මොනවාද rates? Dividend, what is the rate? You can refer the DTA and tell me. If I am sharing the DTA, you keep it, then you can see here dividend, Article 10 is the one you need to refer. Article 10 says dividend is 7.5. 7.5. Then a dividend 7.5, interest 10, interest 10. Then royalty and technical service again 10. Then you can update this schedule. You can update this schedule using your knowledge. Then here you know that the benefit, how 3D is giving benefit to the respective two countries, right? 7.5 source tax. දෙයක් කරන්න තියෙන්නේ 7.5. Then the interest 10%. Royalty 10%. Then technical service is also 10%. Then you know that these are the rate as per the DTA, right? Then I will do the China as well. Can anyone tell me what are the rates according to the China DTA? India and China DTA. Sorry, Sri Lanka and China. Let me open that one as well. Yeah, this is right. This is, I open. Yeah, right. Let me share the screen with you. Right. If you can refer this again, China DTA, Sri Lanka, double tax avoidance agreement between Sri Lanka and China. Right. Here, this one also you can see business profit, all the articles same. There are minor changes, right? Then the dividend is 10%, right? 10%. Dividend 10%. Then the interest 10%. Then the interest 10%. Then royalty 10%. Royalty 10%. Then we don't have technical service fee article separately between Sri Lanka and China treaty. So all are 10 in this case. Let me share the whiteboard again. Within Sri Lanka and China, I am sharing the screen. See, under this, here, the rates is applicable 10%. Here, 10%. Royalty also 10%. This one, what we need to put is not applicable. Right? Then there's question. Sri Lankan company pays 90. Previous example, when the Sri Lankan company taxable income calculate, how much SL company can deduct? Because entirely 100% they can deduct as expenses. Because even if it is withholding tax deducted, the entire cost is 100, because they are paying 90 for the India, 10 for the IRD. Then the total cost for the Sri Lankan company is 100. They can deduct entire 100 and charge to the PNA. No worries. Is it clear? Hope it is clear, right? Right, okay. Then there are active students. So then let me have the critical decision now we are going to take. This is the important part. Then, so I will explain in Sinhala as well. Here, dividend is IRS is 14%. Are we going to apply here? Are we going to apply 7.5 with when we compare with Inner Revenue Act and DTA? අපි මේ දෙක compare කරනකොට IRS says 14%. Then the DTA rate says 7.5. Are we going to apply IRA or DTA? We are going to apply anyway. What is the rate? As per the IRA, DTA rate, because it is more benefited. 7.5 we can apply. We can apply and deduct 7.5 and pay it to the Inland Department, and balance we can remit it to the respective Indian company. They are feeling comfortable. Sri Lanka having less tax rate in the case of dividend. We will invest more in Sri Lanka because they are having lesser dividend rate. Because that is why there are some companies coming through the India. There are some multinational company, they incorporated branch in India, and they are coming to the business and entered into the investment kind of thing through the India to the Sri Lanka. Then they know that 7.5% is the dividend rate withholding tax. Then the entire balance they can take it out. Then this is 7.5. In the case of interest, IRA says 5%, DTA rate 10%. Are we going to apply 10%? No, we are not going to apply 10% because it is more benefited to apply IRA. Therefore, keep it in your mind. We are going to apply this one because it is more beneficial. If IRA says 5%, why we are going to apply 10% as per DTA? This is principal law, is main law is Inland Revenue Act. No. Then we can go with the Inland Revenue Act. If it is more burdensome, we can go with DTA. If it is DTA, we can go with that. Then if the IRA says lesser rate, we can anyway apply as a outstanding. Then we can anyway apply 5%, no worries. Then in the case of royalty scenario, what we need to use is DTA rate. Then the technical services, again DTA rate is more benefited. When it's come to China, again, 10% is more benefited. When it's come to interest, 10% is not benefited because we can go with IRA rate. It is 5%. Right? Then, when it's come to royalty, it is more benefited to apply this one. When it's come to technical service, it is anyway we have to go with this one, the 14%, because there is no any provision. Then when we are going to apply this one, we can't directly apply this 14%. We need to check whether there is a PE. If it is not a PE, then we are not required to deduct. You are not required to deduct withholding tax. In the case of China, you need to check whether there is a PE. We need to check whether there is a PE. Check whether there is a PE. Right? If yes, you are required to calculate the profit. If not, If yes, you need to calculate the profit as per when we are doing taxable profit, taxable profit, profit together with plus minus. You are doing the plus minus now, plus minus together with plus minus. Then you need to pay the tax with whatever the applicable rate. Let's say 28 is the previous, 28 is the previous rate. Now it is 24 standard rate. Right? If it is no PE, if it is no PE, if it is no, let's say no, if it is no, then not taxable. You are taking no tax clearance from IRD. You need to take no tax clearance from IRD in order to remit. මොකද බැංකුවට සල්ලි යවනකොට මේකට ඩිඩක්ට් කරන්න ඕනේ නැහැ කියලා ඒත් බැංකුව නිකන් යවන්න දෙන්නේ නැහැ. ඔයාලට කියනවා ටැක්ස් නැහැ කියලා කන්ෆර්ම් කියලා ලෙටර් එකක් ගන්න කියලා. This is you need to take no tax clearance from IRD. IRD. This is anyway like a business profit. Because this is technical service, not a passive. Anyway, if it is not applicable, if it is no DTA, it is treated as a business. The India treaty එකේ මේක technical service නැහැ කියන්නේ ඒක business කියලා වෙන එක. ඒතකොට business එක නම් ඔයාලට කරන්න තියෙන්නේ මෙන්න මේ method එක. ඒක treaty එක P එකක් create වෙනවද නැද්ද කියන එක බලන්න. So, right? This is very much useful for you, I think. Let me, this is up to December 2000, up to December 2019. Then what you need to do is, I will keep it there for the time being, and with effective from January 1st 2020, you know that there are two rate changes. Then the interest, dividend, there are so many changes happen with the new proposal made to the Inland Revenue Act. Then you know that there are some changes as per the Inland Revenue Act. Then I will draw the separate line with new changes with effective from 1st Jan 2020. Here is applicable in the revenue. DTAs are remain as it is. DTAs I am not going to draw because DTAs remain as it is. This is for basically the new changes, with the new changes. With the new changes, let's keep it here in IRA. With the new changes, how it's come. Dividend, what is the rate now? Now dividend is not, there is no more withholding requirement. Dividend you are making to non-resident person is exempt. IRA says exempt. If it is IRA says exempt, are you going to apply DTA rate? Exempt. You are not required to apply DTA rate if it is exempt. Then the interest, there are some foreign companies, the recent changes, I will share that one as well with you. There are some companies, there are some recent changes they have recently introduced. If the loan providing by the non-resident person, you are paying interest, it is also exempt. The recent proposal. I will share that document. Let me open that first. Right here, if you can, because this document also I shared with you that we have discussed in very beginning. This is the notice reason with the recent changes. If you want to have an understanding of recent changes, you need to refer this notice, right? Then under this, if you can go to the exemption, if you can go to exemption, dividend interest also there, interest accruing interest any person outside Sri Lanka to loan grant to the person in Sri Lanka. This is effective from 1st April 2018. This is they have made it effective from 1st April 2018. Interest paid by any person outside Sri Lanka, derived by any person outside Sri Lanka, any loan granted to a person in Sri Lanka, to any person in Sri Lanka. Then this is with effective from 1st April 2018. Then here also you can refer. Then there are in practically there what happened is practically there are some cases because recent amendment is came April 2020, but up to that point they paid interest 5%. But do you think that we can recover that one? No. But in this case also you can mark it here as exempt. You can mark it here as exempt because recent proposal. You can mark it here as well exempt, right? And then the interest and other government securities, foreign currency accounts, there are some other exemptions, dividend case, uh, to another dividend received, and then dividend paid to a resident company who is member of non-resident person. This is dividend what I have explained here. Dividend paid by a resident company to a member who is a non-resident person. The non-resident person. In this case also you can determine dividend is also exempt, right, with the recent changes. Because the recent changes is apply if it is not clearly specified with effective from January 1st. Here it is clearly specified with effective from April 1st, 2018. Then you know that other balance part we can refer to the whiteboard. The royalty, what is the applicable rate? It is 14%. Right, it is 14%. Technical service, if it is there, it is 14%. Then this is very much useful for you to better if you have understanding of this before 31st without recent changes. The with recent changes also you can have this diagram by taking the relevant DTAs and you can evaluate what is the more beneficial. What is the more benefited to that person, non-resident person. So I will share this one with you. whatever the diagram we have drawn here. Right. Then I will move into the slide again. This is now elimination of double tax avoidance part is the last slide. Then this question is there. I will share with you. Then the balance slide only the what is mainly elimination of double taxation on the tax credit method. Tax credit method actually we discuss how Indian companies getting that benefit by taking, if you can remember or recall your memory, Indian companies XYZ, they were liable to tax 35% and they claim that tax paid in Sri Lanka 10% as a tax credit. Then elimination of double taxation under tax credit method is the one of popular method in Sri Lanka, not the exemption method. The tax credit method is the mostly used method. Then where the income in accordance with DTA has to be taxed in with or without limitation. It is the country of residence. If you can see, DTA has tax with or without limitation. It is country of residence, that obligation to eliminate the taxation. Eliminate the taxation. The resident principle they use for taxing, then the eliminating double taxation. There are two methods. The one is exemption method. Then what is exemption method? Then if the source, the whatever the relevant income, let's say dividend, if the tax is coming under one country, then other country no need to pay. This is exempt because they have deducted from one country. Then there is no more tax. This exemption method. Let's say Sri Lanka tax apply the tax rate is, let's say 14% or 10%. Then there is no more tax in India. This exemption method, one country getting exemption, one country is liable. Then both way also maybe happen. Both country may be exempt sometime because of the some special exemption in order to encourage that sector. There may be some other reasons because of my exemption. Then the credit method is your mostly applicable method when it comes to DTA. So under this principle, taxable, this you can say income that is taxable in a country of source is included when country of resident calculate the tax, right? On the basis the taxpayer's total income. Then the resident resident country, let's say Indian company, as we take that example, Indian company XYZ, they need to pay tax in total income. But tax paid in Sri Lanka, that 10 source. Tax paid in Sri Lanka, that means source 10. Allowed as a credit against its own tax in country of residence. They can take a tax credit 10% in India. So this is the elimination of double tax under credit method. So, right. Then we are now end of the session. Now we will discuss some Q&As from next week, and we will move into the tax administration part from next week onward. Before we wind up, if you have any question, you can raise.